As of right now, on February 2, 2026, the live intraday price for Nuburu Inc. stands at $0.1864, which marks a significant drop of about 11.24% since the opening bell today. This sharp downward movement is happening while trading volume has surged past 10 million shares, showing a high level of churn and perhaps some panic selling from retail investors who are expecting a continuation of the rally we saw late last week. While the mainstream expectation for a penny stock like this often involves high volatility, the reality today is a stark reminder of the liquidity risks and the heavy dilution pressures that continue to weigh on the company's valuation despite its recent headlines regarding defense contracts and technical milestones. Most people look at a stock like this and see a lottery ticket. They think if they can just time the bottom, they'll catch a massive multi-bagger return when the company finally scales its blue laser technology. That is the common expectation, but the reality is that the market is currently pricing in a massive disconnect between the company's technological potential and its actual balance sheet health. While everyone is talking about the defense partnerships in Italy and the new acquisitions, the stock is struggling to stay above its 52-week lows because the sheer number of shares outstanding has increased by nearly 3,000% over the last year. That is a staggering amount of dilution that most casual traders using the Robinhood app or SoFi Invest might overlook when they see a 20% jump on a Friday afternoon. If you look at the recent movement, we've seen a pattern of sell the news. Late in January, the company was touting its transition into a defense and security hub, which led to a 23% spike in the share price on massive volume. Yet today's 11% drop suggests that the institutional players, the ones moving millions of dollars through platforms like Interactive Brokers or Fidelity Wealth Management, are likely using these liquidity events to exit their positions or hedge their bets. The trading volume today is particularly telling. When a stock drops double digits on volume that is significantly higher than its historical average, it tells you that there isn't just a lack of buyers, there is an active push to get out before the next round of financing hits the tape. We have to talk about the institutional activity here because it's where the real story often hides. While retail investors might be using their individual brokerage accounts to pick up a few thousand shares, firms like UBS have actually been increasing their stakes significantly in recent months. This creates a confusing signal. Why would a major institution increase its stake by over 10,000% in a company trading for less than a quarter? The reality is often found in the structure of the deals. Often these positions are tied to convertible debt or warrants that allow these big players to profit even if the common stock price doesn't skyrocket. They aren't necessarily betting on the stock hitting $5, they're betting on the deal flow and the interest they can capture through the financing of the company's expansion. At this point, I want to hear from you. Comment below how many shares of Nuburu you currently hold, or if you are just watching this one from the sidelines waiting for a specific price target. Seeing the sentiment from actual holders really helps gauge whether the retail crowd is still holding strong or if they're starting to throw in the towel. When we look at what this company actually does, it's actually quite impressive from a purely engineering standpoint. They are pioneers in high-power blue laser technology. Traditional industrial lasers usually operate in the infrared spectrum, which works well for steel, but is notoriously inefficient for welding metals like copper or gold because those materials reflect a lot of the energy. Blue lasers have much higher absorption rates, which theoretically makes them faster and more precise for things like electric vehicle battery manufacturing and 3D printing. This is the expectation part of the story, the idea that every EV factory in the world will eventually need a blue laser. However, the reality is that being a pioneer is incredibly expensive. The business model is currently shifting toward a defense-heavy strategy. They are acquiring firms like Lyocon in Italy and partnering with Tekne SPA to move into the defense and security sector. The logic here is sound. Government contracts are sticky, they pay well, and they are less sensitive to the economic cycles that might hurt the commercial EV market. But these acquisitions are being funded through complex share share offerings and convertible loans. This is why you see the stock price struggling despite good news. Every time the company secures $20 million to grow, they're essentially issuing more shares, which makes each existing share worth a little bit less. For those of you doing your online investing through something like Schwab Intelligent Portfolios or using various investing sites to track your performance, you know that micro-cap stocks like this are the ultimate test of risk management. The intraday movement we're seeing today is a perfect example of why self-investing requires a high degree of discipline. If you bought in during the hype on Friday at $0.21, you are now looking at a double-digit loss in a single session. This is why professional traders often prefer the Fidelity trading platform or interactive brokers because they need that split-second execution and deep liquidity that isn't always available on the more gamified apps when a stock starts to crater. Looking at the older reports and past performance, the company has consistently struggled with its burn rate. In the most recent quarterly filings from late 2025, the revenue was almost non-existent compared to the massive operating losses. They reported a net loss of over $60 million on a trailing 12-month basis. When you compare that to a market cap that is currently under $100 million, the math is tough to ignore. The company is essentially in a race against time. They need their new defense contracts to start generating actual cash flow before they run out of the ability to raise more capital from the market. This brings us to the future outlook and the catalysts that could actually change the narrative. The expectation for 2026 is that these defense partnerships will finally move from the signing phase to the revenue phase. The company has explicitly stated that they expect revenue from the Tekne partnership to start hitting the books this year. If they can report a quarterly earnings statement that shows even a modest jump in actual sales, not just strategic milestones, that could be the reality that exceeds the market's current low expectations. Right now, the market is expecting them to keep diluting and keep losing money. If they can break that cycle, the upside could be significant. However, the risks are just as large. We are looking at a company with a current ratio that is quite low, meaning they don't have a lot of liquid assets to cover their short-term liabilities. If the defense contracts get delayed or if the stockholder approval for their next round of acquisitions falls through, the stock could easily test its all-time lows again. Investors using SoFi Active Investing or Robinhood fractional shares need to be aware that the price of $0.18 is not necessarily a discount if the company is forced to do a reverse stock split to stay listed on the exchange. In the broader context of the sector, we are seeing a lot of interest in defense tech. With global tensions remaining high, the demand for dual-use technologies, things that work for both factories and the military, is at an all-time high. This is the tide that Nuburu is trying to ride. But unlike Nvidia stock or Apple stock, which have massive cash reserves to fund their research, a small player like this is living hand-to-mouth. Even Tesla stock, which had its own near-death experiences, eventually had a product that the mass market was buying in huge volumes. Nuburu hasn't reached that point of mass adoption yet. If you're looking for investment help or trying to find the best online investment for a small portion of your portfolio, it's important to differentiate between a trade and an investment. Today's movement looks like a trader's nightmare, but a potential entry point for someone who truly believes in the blue laser thesis and has the stomach for a 50 or 60% further drop. Most people who use the Fidelity mobile app for their long-term Fidelity ETFs or Fidelity mutual funds would likely find this stock way too risky for a core position. It belongs in the speculative bucket, and today's action proves why. To summarize the situation, the expectation was that the defense-centric pivot would provide a permanent floor for the stock price. The reality is that the market is still more concerned with the company's cash burn and the massive increase in the share count than it is with the potential of Italian defense contracts. We are seeing a classic show-me story play out. The stock is being punished today because, despite the news, the financials haven't caught up to the press releases yet. The central insight here is that technological superiority does not always equate to stock market success, especially in the microcap space. You can have the best laser in the world, but if you have to sell 200 million shares to keep the lights on, the stock price is going to stay suppressed. The gap between what investors hope will happen and what the balance sheet says is happening is where the current volatility lives. Until that gap closes with actual, verifiable revenue, we should expect more days like today where double-digit swings become the norm. Keep a close eye on the volume over the next few hours of this session. If it starts to taper off and the price stabilizes around the $0.18 mark, we might see some consolidation. But if it breaks through the support levels we saw earlier this year, it might be a long road back for the bulls. The authority in this space belongs to those who look past the defense buzzwords and actually read the fine print in the SEC filings regarding share offerings. That is where the truth usually sits. Would you like me to analyze the specific terms of their recent convertible debt offering to see how it might affect the share price in the coming months?